The Fed right now is front and center. You look at the inflation data we saw just in the last couple of days. We got wholesale inflation yesterday, the PPI. We're running at 6.9% core year over year. The CPI we got last Friday, 4.9% core year over year. And then the core PCE is probably running at about the 4.5% level. Those numbers are more than twice what the Fed wants to see. So what we think we're going to see this afternoon at 2:30 is a significant acceleration of the tapering program that the Fed laid out just a month ago. They've been tapering at a pace of $15 billion a month in November and December. We think they doubled that to $30 billion a month in January, February, and March. That means the taper will be completed by the end of the first quarter. And what that sets us up, we think, is for a series of quarterly quarter-point rate increases over the balance of calendar 22 and calendar 23. So by the end of 23, interest rates, Fed funds rate level could be 175 basis points higher than they are now. And I think that's exactly what the market's focused on.
1.75%. Now, the big question, Phil, would be this. Can stocks, and I say stocks meaning like generally the S&P 500 or groups of stocks, can they survive and thrive during a series of rate hikes, or will it knock the knees out of high multiple, fast growth companies like some of the favorite tech names of maybe your clients and the CNBC viewers?
I think you're spot on. So stock market was up 25% this year. We're up 117% since the bottom of the market in March. That's not what we expect going forward. Earnings next year will be up a more pedestrian 8 to 10%. Stocks, I think, are going to track that, up about 10%. Our target for the full year is 5,300. The key issue is going to be what to buy. The value stocks are trading at about 17 times forward earnings. The technology stocks, the growth stocks, about twice that, 34 times earnings. And it's these value stocks that have the pricing power that can increase their prices, increase their margins based upon the higher wages, shipping costs, commodity costs. So it's the cheaper value stocks with pricing power in the U.S. market, along with small cap and international stocks. You've got to go cheap here, and I think it's the more attractive names that are going to provide some alpha next year.
Is the just juggernaut run of super cap tech, high valuation, high multiple, nobody looks at their balance sheet, no one looks at their income statement, just buy the stocks and hold your nose. Is that over, Phil? Are we going back, to the, like you said, the days of just you want slow and steady, you want cyclicals, we've said it, boring, maybe the new sexy?
Well, you've certainly, the picture that I've just painted is one for much greater volatility next year in terms of what is Fed policy actually going to be, and how will the economy respond, how will the financial markets respond. So the much higher beta, higher PE technology stocks, we think are likely to be more at risk than the lower beta, lower PE, higher dividend value stocks. So I think you've got to play a little bit of defense here as you look forward to next year. We think it'll be a good year, but value, small cap, and international, we think will be the winners over the course of the calendar year.